You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you are doing well on this Tuesday. During my morning run yesterday, I listened to the Canadian Investor podcast with Simon and Dan. And honestly, that was like a really, really good episode. They spent half of the episode talking about Constellation Software and the other half about covered call ETFs. So that was like super interesting. Love those guys. I like their the way they're trying to be like based on facts and not necessarily just try to pull out an opinion. But of course, we all have our bias. But anyways, if you have a chance, take a look at it. It's just like a great episode. And I wanted to come back on Constellation Software and the fact that it's kind of like overvalued right now and why it doesn't matter at all. So if you want to go like the full 30 minutes, just go on the TCI podcast and listen to the pros and cons. Interestingly enough, Simon doesn't hold it and then had Dan invested it in it. So that kind of like give you like the both perspective. And it's interesting to show you how it's important to have a solid investment thesis for a stock and then having solid metrics. But if you're missing one or the other, you probably should not invest in it. And something that came out of that podcast is like Simon doesn't believe enough in the investment thesis. And that's totally fine. The point is not to be right or wrong here, because you're only going to know if you're right or wrong like in 5 and 10 and 15 years down the road. The point is, if you do not have a high level of conviction in the investment thesis, the reason why you should invest in a stock, well, that's your ultimate signal that you should probably not consider it for your portfolio. That's part of like doing your due diligence, right? So again, Constellation Software, relatively complex company. They keep on acquiring small software companies that are offering like kind of like subscription-based products. So that's pretty much their motto. They're making like a bunch of deals, very small deals, like hundreds of companies being bought out all the time. And this is how they grow. So they don't grow super fast organically. Usually their organic growth is around like 2-3% maximum. But the revenue is growing by more than 20%. It's kind of crazy. And what happened recently is they had their annual meeting, and then Mark Leonard, that is the genius and the CEO behind this company, just said, you know what? The stock is pretty much overvalued. And that's interesting because I think this guy's been saying this for like the past 15 years or something. So at one point, this is one of the reasons why I don't think it matters so much. But let's do a deep dive here and talk a little bit more about Constellation. So the first reflex, you would maybe say, oh, like, and that's a wrong reflex. The shares are around $5,000. That's way too much expensive. Well, first, $5,000, $10,000, could be like $100,000 a share. It doesn't matter. It doesn't matter because you could, in this case, have like 500 shares at $10 each, and that would be the same investment as one share in Constellation Software. I get it. It feels weird to buy, like, for example, have like 5 shares. It feels weird to have only 5 shares of a stock, but it still works. It's exactly the same thing. So then the good reflex you should be having is to look at valuation metrics, like such as the PE ratio, right? And PE ratio is usually between 80 to 100 times the earnings. Right now, the forward PE is around 40, which makes a little bit more sense, but in general, it's kind of like crazy like this. First, keep in mind, for a company like that makes like hundreds of acquisition, there is a lot of amortization and other like acquisition charges and stuff that will hurt the PE ratio, but for the long run, it's probably not as precise as looking at maybe the forward PE ratio or maybe using like other type of valuation metrics. But overall, you're probably going to feel that it's still overvalued. But you know what? When I pulled the trigger in 2022, the shares were at $2,000. They were roughly trading at an all-time high. They doubled in value between like, I don't know, like 12 to 18 months. They doubled in value. So that was like all the signals to tell me that I should not buy, because It was overvalued at 2000, and keep in mind now it's trading around 5. So just to show you how it doesn't really matter that much. But why does it matter that much? Because the valuation is literally a perception. You're going to say, oh, Constellation Software, very bad investment, too expensive. And then you're going to look at another stock that is struggling, trading at a P ratio of 8, and then you may be thinking that you're getting a deal. But maybe it's trading at a P of 8 just because nobody wants to invest in it, because it has like poor growth perspective and the company is actually struggling and it's going nowhere. So you have to keep in mind that sometimes it's just a matter of like perception and not necessarily a good or a bad deal. In fact, if you look at the reason why investors are willing to pay that kind of crazy price for Constellation Software, well, first you have to understand like the business model a little bit more. So the company is reinvesting all its free cash flow into new acquisitions. So as it grows, and it more than doubles its free cash flow over the past 5 years, cash flow from operation, same thing. So they are spending more and more and more into new acquisitions, that those new acquisitions are generating more and more cash flow. So you can see the snowball rolling here. So the free cash flow right now is getting around like $3 billion per year. The company only has like $5 billion in debt, and the market cap is above $100 billion. So very large business, almost no debt, generating ton of cash flow that is actually being reinvested inside the business to make new acquisitions and to keep up compounding those revenues by more than 20% per year. And that's the other reason why you have to pay such a high price. The company is compounding at more than 20% per year. That's kind of crazy, right? How many companies do you know in your portfolio that does that? Not too many in mine, that's for sure. And the secret is, of course, that snowball that keeps on going. So they are operating in a very niche acquisition landscape, like small deals, vertical software, generating cash flow, small business. They keep the owners in place and they have their playbook to improve the business, and they just rinse and repeat all the time. So for those cash flow generation abilities, it just makes like such a great company. Now, the thing is, of course, I'm super happy about it. Definitely biased because I'm making money on it. So, I mean, full disclaimer, I'm super like happy shareholders there. Is it the perfect stock? Well, unfortunately not. There are downsides, and you have to consider those as well. Because while the stock is kind of like priced for perfection, like investors are expecting that 20% plus compounding effect, and that's why they're willing to pay such a high price for the stock. Well, the company will eventually struggle to reinvest its capital going forward. It's going to be tough to invest first billions of dollars. So you have like more and more money to invest. So you need to find more and more deals. And then you have to find deals that will meet that expected returns of like 20% plus. So you have like two problems here, like too much liquidity. And on the other side, the expected returns when you invest that money is like out of this world. So very difficult to meet the market's requirement for that. And on the other side, there's not much they can do with that extra capital. I mean, if they would increase their dividend, that would send a very bad signal. A lot of investors would say, oh, there you go. Like the golden days of Constellation Software are gone. Now they have become a mature business. They're paying a dividend, and that would probably sink the stock price, because right now the stock price is priced for a company that will grow double digit. So yes, it would be fun to get a dividend out of that, but the signal that tells you, oh, the business is not able to find opportunities anymore, well, then the entire investment thesis has to change. And that is the bad part. They could pay off debt, but I mean, that's going to take them like a little bit like more than a year, and they would be completely debt free. So not going to have like a big impact here. It's not a burden. It's probably like kind of like use this. Buying back shares, Mr. Leonard has been kind of clear on that they will not do this. So there's not much they can do besides reinvesting somewhere else, right? So they can target bigger deals. That could be interesting, getting outside of their niche. They could target other verticals. And they are exploring those kind of deals, those kind of like shift in strategies to continue making acquisition, but kind of like modifying their playbook a little bit. And when you modify a strategy, well, of course, it could bring a ton of money more, but it could also hurt the business and not generate the expected returns. So is the stock is perfect? No. Would like to buy it at $2,000 instead of $5,000? Definitely. But is it something that will necessarily happen in the future? I don't know, my friend. I just don't know. Maybe it will, maybe it not. But in the meantime, I'm super happy with my shares. And here's the thing. When you have a very high level of conviction in a stock, and then you have like numbers like cash flow from operation, free cash flow, revenue, earnings, everything is going up like there's no tomorrow. Well, both of them work well, right? Good metrics, good investment thesis. I'm a happy shareholder, and I don't really care about the valuation because your guess is as good as mine as how much much is worth Constellation Software, and we are probably both wrong anyways. So right, Moose, that's enough for today. Tomorrow we're gonna look at my best performing Canadian stocks so far this year. That's gonna be an interesting one. All right, stay tuned and stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.